now to break down some tips and tricks for investing over the long term is IBD's personal finance and management editor, Matt Krantz. Thanks for joining me today, Matt.
Thanks for having me.
All right, so we have active investors, can slim, position traders, really keeping a close watch on their individual holdings. And then we have passive investors who are looking to maybe set it and forget it, but they still want big gains over the long term. So when you're thinking about how to handle your portfolio in the long run, what are some things that investors should know?
Yeah, the key is, and you touched on it, is you kind of have to know what kind of investor you are. If you're an active investor and you like to pick individual stocks, that's great. And most likely you're going to make giant gains over the years if you have a system that works, like Can Slim, and you stick with it and you monitor it and you watch it and you subscribe to IBD Live and you listen to all the experts that we have here that tell you how to monitor the markets for individual stocks. But there's usually a part of your money too that's more long term. And this is usually mutual funds, ETFs, retirement accounts, 401ks, IRAs. And this is kind of a different animal because this is money that you're going to put away for 5, 10, 15, 20, 30 years. And this isn't money that you're necessarily getting in there and making strategic changes all the time. In fact, usually the best way to make money long term without making strategic changes like what you hear about at IBD for tactical changes with individual stocks is by picking a strategy and sticking with it over the long haul and not trying to make major swings just because the market makes such kind of a shift day to day.
Yeah. Well, what if I think Amazon has a long runway of growth ahead for it? It's been a market leader for a while. What should I do about setting and forgetting something like that?
And that's a great point. I mean, when you look at the market this year, it's been really kind of carried by just like 4 or 5 companies. Some little companies too are really erupting out of nowhere, like Zoom Video. It's up so much this year. I'll probably never make that much money on my 401k in my entire lifetime that people made just this year. But the fact of the matter is these individual stocks are very volatile and they need to be watched and you need to respond to them from a day-to-day basis. When you're going longer term, you want to own broader baskets of stocks. Bill O'Neill, our founder, he used to always say, when you pick a great mutual fund, you identify a great mutual fund, you buy it, and you never sell it. And I think that's great advice with mutual fund long-term money. You identify the winners. You either find the managers who have skill to pick the best stocks for you over the long term, or you can identify themes or ETFs or low-cost index ETFs that pick major asset classes, be it the S&P 500, or be it small cap, or be it growth stocks, and you just let it ride over the years, and you don't want to be second guessing that part of your portfolio.
Yeah, well, there are thousands of funds to choose from, so how should investors pick the best ones? How do you know, even if it is something that's broadly diversified, how do you pick the best place to park your money?
Well, IBD does a lot of the homework for you. We have a best mutual funds section on our website, and we also publish it in our newspaper, where we identify the very best mutual funds over the long term. These are the funds that have delivered year after year, after decade, and have the best, most skilled advisors and managers that we can find. Because you have to keep in mind, at least 80 or more % of mutual funds underperform the S&P 500. And that brings me to my next point. If you just want a low-cost way to play the market, it's really hard to beat the index funds. A fund that invests in the S&P 500, say Vanguard's VOO, Victor, Oscar, or even the Spider, SPY, super low cost. If you're in a portfolio that's 60% stock and 40% bonds, if you put 60% in an S&P 500 fund, and that's your long-term money, it's going to be really hard to find mutual fund managers that are going to beat that.
Well, if I am looking to get a little bit more creative than an index fund, and I like investing in growth stocks, there are thematic ETFs out there as well that investors can consider mixing in when you're diversifying that long-term portfolio. When you're deciphering among those, what are some things to consider?
That's a great point, Allie, and I'm glad you brought that up. The S&P 500 is great. It does a really good job with large cap blend stocks, but it's kind of like a mallet. And it's not the kind of thing you're going to use when you want to do some delicate work. In fact, it has some major gaps. So one major gap that it does have is, say, cloud computing. There are some smaller cloud computing companies that are coming on strong. Take a Zoom, that's not in there. So there are thematic ETFs that let you focus on areas that are missing in the S&P 500. With that said, there's also areas that are overweight. So energy, as we know, is a dumpster fire. It's been a complete and utter disaster, not just this year, but for many years. And you own all that stuff when you own the S&P 500. So to counteract that, you might want to build in some themes that kind of shift you away from that, like maybe innovative web or other areas as well.
Yeah, and I guess the other thing too to remember, or at least think about, is you want to make sure that it's not a theme that might just be a flash in the pan, like pot stocks were all the rage when some of those first went public, but we're not really seeing the results there. So how do you balance when it comes to investing in thematic ETFs, but really trying to focus on the long-term performance?
That's a great point, because as we said earlier, when you shift too much in your long-term portfolio, you're almost dooming yourself to subpar returns. And there's always a tempting thing out there. Electric cars, it's tempting, but now, as we're finding out recently, there's a lot of volatility in there. So that's, again, where ETFs can really come into play. So for example, video games, not a fad. They've been around for decades. It's the largest form of at-home entertainment now, even bigger than movies. You could try to pick an individual winner, but man, that's tough. So there's ETFs that you can buy that give you like an amalgamation of all the leading video game companies, not just in the US, but across the world. So if one of them has a blow up or a dud or a lemon, you're diversified and you own the ones that work. So to me, that's a classic case of where you can use a thematic ETF to kind of bolster a long-term portfolio.
Yeah, and making small tweaks along the way. How do investors decide between kind of sticking it out with something that they're not really short term seeing a lot of success with, and shifting that capital elsewhere to try to boost those returns?
Another great question. I'll give you two examples. So one long-term asset class that makes a lot of sense for a lot of people are small cap stocks. Small cap stocks are highly volatile. They're enough to just keep you up at night sometimes. They're unproven, they're risky, but man, do they deliver over the long term. Small cap stocks, because of their off the charts risk, tend to do really, really well over the long period of time, which we're talking about. So you may get a year where you're down 20% on your small caps, and you can buy small cap ETFs. But in that case, you want to stay the course. But there's other asset classes that aren't like that. So one that's just bringing a lot of attention right now are value stocks. The academics tell us that value stocks are superior over the long term, that they are riskier, that they're cheaper, so they give you a better return. But you know what? They just have not delivered. They've lagged growth stocks for 10 years. This has never happened in history. And I've talked to advisors, the clients they've just had it. And what they've realized, the advisors say, look, the academics may be right. It may be possible that value stocks are better in the long term, but you know what? We're human. And at some point, we can't bear the pain. And advisors that even specialize in value stocks are having their clients say, I'm done, get me out of this. So what they've learned is that our threshold for pain has to be factored in as well. And even though something should happen, it doesn't, you need to make an adjustment, or you're just going to make a bad decision. So a lot of these value managers are starting to shift into growth because their clients just can't take the pain anymore.
Yeah, well, there's a lot to consider, and we do know that without risk, there's no reward, but investing over the long term is something that is so very important. So we really appreciate all of these takeaways today, Matt.
Absolutely. Thanks for having me.
Hi there. Thanks so much for watching Investing Strategies on our YouTube channel. If you want more executive interviews and analysis of key trends to watch, make sure you hit the subscribe button so you can stay up to date.